Today I'm going to talk about SRS, Supplementary Retirement Scheme, and how to use it to save tax, and also some issues you need to take note of if you were to use SRS. If you're new to SRS, I will go through how it works first so you have a better idea on how it can help you to save tax. Basically, for Singaporeans, you can actually contribute up to $15,300 a year into SRS, and if you're a foreigner working in Singapore, you can actually contribute $35,700 into SRS. So every dollar that you contribute to your SRS actually reduces your chargeable income by $1, and therefore it saves you tax based on your prevailing tax bracket. Let's take someone who earns $120,000 a year, for example, and after deducting the usual tax reliefs like earned income relief of $1,000, CPF of $14,400, the person's chargeable income is now $104,600. He will fall into the 11.5% tax bracket, and he has to pay a tax of $6,179 if he doesn't contribute to SRS. If he decides to contribute the maximum $15,300 to his SRS account, his chargeable income falls to $89,300, and his tax payable is now $4,419.50. That's a tax savings of more than $1,750, and that's essentially 11.5% times $15,300, the amount that he contributed to SRS. So you just take the amount that you contribute to SRS and then times the tax bracket that you fall into, and that's your tax savings. The purpose of the Supplementary Retirement Scheme, as the name suggests, is to help you with your retirement. So once you reach your statutory retirement age, currently 63, you can actually withdraw from this account and get only 50% of the amount withdrawn taxed. So if you are withdrawing $40,000 when you are 63, what happens is that only $20,000 is taxed, and $20,000 happens to fall under the tax-free rate under current income tax rates. Once you make your first withdrawal after your retirement age is reached, you actually have 10 years to spread your withdrawals, and therefore you want to make it in such a way that you minimize your tax, typically by spreading the amount across 10 years. So let's say you have $400,000 in your SRS account, you can actually spread them across 10 years, and you actually pay $0 in tax because only 50% of it is taxed. So $40,000 of income from year 1 to year 10, each year you are only taxed on 50% of that, meaning to say you pay $0 of tax. And if you have $800,000 in your SRS account, you can spread it across 10 years, taking out $80,000 each year, and you will only be taxed on $40,000 of it, which is about $550 according to the current tax rates now. This video is brought to you by Moo, and you should definitely sign up using my link below because you can get free shares to kickstart your investment journey and also get no commission if you trade on US stock market, and you can also get pretty low commissions if you trade on the SG stock market. Check out the latest promotion with my link below and score yourself some free shares and goodies. Every sign up goes directly to helping me create more content for this channel, and I thank you for signing up, and thanks to Moo for sponsoring this video. So SRS is a very good scheme for you to reduce your tax payable, especially if you are in a higher income group and paying more than 7 or 11.5% of tax. And it helps you to save on tax right now when you're financially productive and drawing a high income, and then draw down on your savings when you are either earning less or earning nothing at all during your retirement age. But there are some things that you do need to take note of, and I'll cover 3 things that people take issue with SRS. SRS will invariably draw comparisons with CPF, which gives as high as 4 to 5% per annum interest on your CPF savings. In comparison, SRS only gives you a pathetic 0.05% per annum interest. So after you have contributed to your SRS and gotten your tax savings, you should not leave your SRS money idling around earning that very pathetic interest, because you lose it to inflation, which is all the more relevant now as we live in high interest rate environment. You should definitely invest your SRS savings, but do note that your investment choices are limited to a short list of options. This includes some type of endowment insurance, stocks, shares and bonds listed on SGX, unit trusts. You can also put your money into Singapore government securities such as SGS bonds, SSB, as well as T-bills. And you can also consider bank fixed deposits, which are now pretty attractive given the higher interest rates. And lastly, you can also invest in some robo-advisors who are licensed to accept SRS savings. Some have criticized this list for being too limited and restrictive, but I think it actually saves people from themselves. You can't invest in very, very risky things like cryptocurrency, and that actually has worked out quite well for people who have been investing in SRS because they avoided the whole crypto crash that has happened over the past few months. And my belief is that you should actually invest prudently, and your SRS can be that vehicle for more prudent investments. Now check out the description box if you want to know what I'm personally invested in my SRS. Things can change from time to time, so I'll update it when there are any significant changes. Another criticism I heard of SRS is that it locks up your money until your retirement age. And for people who want to retire early and live the FIRE dream, it is not so suitable, but I actually beg to differ. Now, I'm someone who wants to retire early and attain FIRE, and I feel that SRS is actually perfect for people who want to reach early retirement. Now, this is because, unlike your CPF money, SRS is not completely locked up. If you want to make an early withdrawal before your retirement age, you can actually do so. You just have to pay a penalty of 5% plus the prevailing tax rate of such a withdrawal. For example, if you have $100,000 chargeable income and you wish to withdraw $10,000 from your SRS, you have to first pay a penalty of 5% and then the prevailing tax bracket you're in, which is 11.5%, making a total penalty of 16.5% on such a withdrawal. Now, this of course does not make sense, but let me illustrate another example where early withdrawal can make sense for people who want to retire early. Let's say you are now in the 11.5% bracket and you contribute $10,000 to SRS. And in 1 or 2 years' time, you wish to retire and you totally do not have any income, and you withdraw this $10,000. What happens is that you now pay 5% penalty, but there's actually no tax to be paid because now you have $0 income, and therefore you pay $0 tax for this $10,000 withdrawal. In fact, if you are not totally without income and still have, let's say, $20,000 of income, and then you withdraw $10,000 from your SRS to supplement your livelihood, you pay the 5% penalty and then 2% tax on that $10,000, and overall you still save on tax because you avoided paying 11.5% of tax earlier when you contributed, and now you just need to pay 7% tax on this withdrawal. Therefore, even if you want to retire early, SRS can be used in such a way that it still reduces your income tax in your actively working years, and when you decide to retire at, let's say, 30, 35 or 40, you can feel free to withdraw from your SRS. As long as you don't incur more tax than you save, you are better off using SRS than without it. In fact, I think SRS is even more important for people like us who want to retire early because we tend to work multiple jobs and then our income will increase such that we fall into the higher tax brackets. And it's even more important for us to save on our tax contributions. And then when we retire, take it easy and reduce our incomes, we can enjoy the tax savings despite the 5% penalty. I think it is a very good strategy to consider because our CPF is locked up all the way until 65, and therefore SRS is actually the one that we can count on for our early retirement. One last criticism of SRS I've heard is that by contributing to SRS and investing, you're actually exposing yourself to capital gains tax, which is something that is not currently taxed in Singapore. When we invest $10,000 and it grows to $15,000, that $5,000 profit that we earn on our investment is actually not taxed in Singapore, and therefore we do not have a capital gains tax. However, if we were to contribute $10,000 to our SRS and then it grows to $15,000, when we make withdrawal on our SRS, there is tax implication, and therefore it can be said that there is some capital gains tax when we contribute to our SRS. And this is indeed true. If you were to check the government's website on SRS, they say that investment gains are tax-free before withdrawals. And it's been asked often enough that there's actually a FAQ page that points out whether or not the government is trying to introduce capital gains tax. Now let's see whether or not this capital gains tax will affect someone adversely if he were to contribute 25 years of $15,300 each year, and then it grows at 5% per annum returns. This person will get $766,000 or so in his account, and he can spread it across 10 years to withdraw about $76,000 each year. When a person makes his withdrawal after his retirement age is reached, he is only taxed on 50% of his withdrawal. So by withdrawing about $76,000 each year, he's only taxed on $38,000 per year. And the amount of tax will work out to be about $491 per year, or $4,900 over the 10 years. If the person is in the 7% tax bracket, he will have saved more than $1,000 per year in tax savings. And if you multiply across 25 years, he saves more than $25,000 of tax. And therefore, it can be quite evident that you should still continue to contribute to your SRS, even though there is a capital gains tax, because ultimately, you still defer your tax to a later time. You pay less tax overall because 50% is not taxable. And also, let's not forget that you are saving tax now and then you're paying a lower amount of tax in future. Therefore, if you have spare liquidity, I would suggest you contribute to your SRS to help supplement your retirement. How about someone who wants to withdraw the money in the near future? Does contributing to SRS still make sense given that there's a capital gains tax? Well, let's look at someone who contributes $15,300 in a single year and it grows at 5% per annum for, let's say, 6 years. His $15,000 have grown to $20,550 and he wishes to withdraw this sum in its entirety. What happens is he has to pay a 5% penalty and then a 2% tax on the $500 in excess of the tax-free $20,000. He now has to pay about $1,035, which is about break-even with the tax savings that he has gotten. But let's not forget, this is $1,035 in future, 6 years from now, which theoretically has a lower value than $1,000 now. And also, the $1,071 that you have saved on tax this year can grow over the next 6 years at 5% per annum too and reach about $1,400. So there is still some savings in tax that can be enjoyed if you are contributing your SRS when you are earning more and then withdrawing when you're earning virtually nothing at all. And that should be a situation where you are actually withdrawing from your SRS when you have no income. If you have other income 6 years from now, then by all means don't touch your SRS and only withdraw it when you can enjoy the 10-year 50% tax discount. And my take, and this is not personal financial advice because I'm talking to all of you here on YouTube, is that you probably shouldn't contribute if your tax bracket is in the 2% or 3.5%, because at that income level, liquidity is probably very important to you and you should just store it all in very liquid funds. Okay, now SSB T-bills give very, very good rates. But if you creep up to 7%, you should probably consider doing it. But if your income tax rate is 11.5% up, you should strongly consider putting funds into SRS if you haven't already done so. Not only does it help you save a lot of tax, it also takes away a lot of emotions from investing because now you have earmarked this as your long-term funds and there's a penalty for withdrawing early and therefore it shapes your mind to treat this as long-term investment. So that's another benefit of SRS that is not often talked about as well. Now, even if you're not convinced on the merits of SRS for now, you should definitely still open your SRS account and put your first dollar in because it will help to lock in your retirement age at 63 and allow you to withdraw at 63 and only have 50% of the withdrawal taxed. If you were to wait for retirement age to increase to 64 and 65, your retirement age will then be at 64 and 65 for your SRS account. So do it before they raise the retirement age. If you like my stuff, do drop me a like and subscribe to my Telegram group for more relevant content and great deals. And since you are watching a video on SRS, I think you'll be highly interested in this video that talks to you about other ways that you can save on your income tax. So tap here and I'll see you in that video.